welcome back, traders and investors, to the Benzinga Pre-Market Prep. This is Garrett Cook here, sitting in for Joel Elconin. I'm here with Leon LaBrecque, founder and CEO of LJPR. Leon, welcome to the show.
Good to be here.
How are you doing today?
I'm great. It's cold here in Michigan, but other than that, it's still great.
Yeah, I know. Tell me about it. Well, before we get into a few things here, I actually want to talk to you about oil. Apparently, you have some very interesting things you'd like to talk about, but I just wanted to ask you your education background and your market background, what you've been up to for the past, it looks like 25 years here.
Yeah, actually longer than that, unfortunately. Started out as a CPA, worked at Arthur Andersen, where I successfully shredded papers. No, I'm just kidding, but I did work at Arthur Andersen. And went from there to law school, got my JD, then started a master's program at one of our local colleges. Very interesting. It was the first Master of Science program of finance in the country.
Ooh.
And we put a CFA tail and a CFP tail on that, so I went and got both of those too. So I have too many degrees. I have to get 2 business cards. So.
Well, can you tell me a little bit about this Masters of Science and Finance? This sounds quite interesting to me.
It's been great. We decided to go with a Master of Science in Finance, and the college I worked at, Walsh College, is one of the top business schools for upper division. So we do graduate school programs in accounting, and we were famous as an accounting school. We actually had a higher number of Sells Awards winner than Harvard or University of Michigan. It's literally one of the top 9 schools in the country in taxes and accounting.
Wow.
And I always had a love of finance, even though I was a CPA and a tax lawyer. I thought it would be great to turn finance into the same thing, and one of our processes was to take finance degrees and get those up into the same level of caliber. So we've just added, and I've actually financed a part of a wonderful state-of-the-art finance lab. We have 14 Bloomberg screens, and we have a video wall, and we can collaborate. So I can have 14 students collaborating on a project. So somebody can be looking at West Texas Intermediate, somebody else can be looking at Libyan crude, and somebody can be looking at world oil supply, and somebody can be looking at Gazprom's price. I mean, it's just really neat. So you get this wonderful collaborative technology effort. And so last year I gave the students $100,000 of my money to go invest in Michigan stocks, just under the same idea, giving us some hands-on experience. So it's really fun, and I'm a giant fan of education. That's 40 years of my life has been educating people about finances.
Goodness gracious, where were you when I was in college? I would die for a Bloomberg when I was going back to school in Buffalo. That would have been fantastic. Now, these students, when they managed that $100,000, how did they do on it? Because we did the same thing for the endowment, but sadly we were doing this during the 2008 to 2010 drawdown, so we didn't really do too hot with some of the picks that we had bought, early on before, we bottomed in 2009. But how did students do with their capital looking at the Michigan finances?
They actually beat the straight-weighted Bloomberg Michigan Index, which was good. They didn't beat the S&P 500, which was bad, but they gave me a positive rate of return, which I was pleased with. So the interesting part was they froze deer in the headlights at the beginning because it was live money. Because I had a shadow portfolio and a live portfolio, and the shadow portfolio, oh man, they just jumped in and they were going to go off and do all these things. The live money people were way afraid to lose money. They were very risk averse. And they were almost timid. I finally had to have a meeting with them and said, I'm paying you guys to invest my money. Do it. And so they did. And it was really interesting.
Well, it's good that they got that out of the way. That seems to usually be the problem, is pulling the trigger early on in some of this stuff, and you kind of got to ease into it. Apparently, that kid that won and apparently just recently lost $72 million, he wasn't really out in the real world either playing it. But, the simulated trading is different, too. I like them both. I'm a fan of both of those, so good for those guys.
Well, I am, too. And the nice thing about our lab is that they can do simulated portfolios all over the place. They can really have, the Bloomberg lets them set up, simulated portfolios. In fact, at Walsh, we had the top 3 students in the Bloomberg Challenge in the last 3 months in the whole world. That's how good they are at it.
Do you just have the students do like the stock challenge and the portfolio management challenge, or do they also do some of the economic stuff like the college Fed challenge and things like that?
We are now upping the ante. I'm actually adding in now a scholarship for the winning teams. So if they can beat the indexes, I'm going to pay some of their tuition.
Wow.
So now there's more skin in the game, and now we're upping it. So we're actually putting some analysis in there and giving them some analyst class. I'm bringing in some of our managers that we use, and they're going to come in and give lectures. And so we're really trying to up the game now. We're upping it because the first year all we did was a portfolio. The second year now we're going into the second year, and we're really excited about what's going to happen next.
Wow, that's fantastic. Well, let's hope they're listening because I kind of want to discuss a little oil with you. So maybe we can get these guys to do a little strategic movement here. We've got oil that's coming back down after the slight rout that we had coming Monday night when we pushed up around 63. What you got any views on oil? There's all kinds of interesting dynamics here. So I'm kind of curious if you've got an angle or something that's of interest to you.
Well, I really like what the Saudis have given us, which is a QE4 for the world. I mean, literally, we have a tremendous thing going on here with these low oil prices, and I think a lot of people are undercounting how much that really means in the hands of consumers because, everyone's saying, oh my gosh, oil prices being low really hurt the United States economy. I go, you're forgetting something. We still don't export oil. This hurts an exporter and does not hurt an importer. And right now, it hurts our frackers, and it hurts a little bit on our producers. But clearly, in the hands of the American consumer, we're looking between $100 and $260 billion of tax-free money sitting in the hands of American consumers alone. But add to that, Europe just got a bonus, and China just got a bonus. And so the oil exporters gave us a really wonderful early holiday present, and I'm just delighted with where that goes. The thing I'm seeing right now that's kind of interesting is it looks to me like the spot market in oil still's got a little bit of downside to it, because of all the futures contracts out there. And after those get covered, I think oil is going to crater and then turn around coming the other way. So right now we're looking at the opportunity, we think very shortly, to be going back into natural resources and getting into some of the natural resource plays. Things like the big oil producers like Chevron or Exxon or Conoco. And then if you had enormous guts, if you really got the real wild play, you want to go take a wild play, go look at Gazprom, which is the ruble-denominated oil producer, but a gigantic oil exporter.
Oh, huge.
And if oil does turn around, there's where you're going to see some real action.
And I would kind of expect an oil turnaround, too. We were talking earlier in the week, and, I was thinking some of the guys that have bigger money and they're actually deeply invested in this, they don't tend to do knee-jerk trading. So when you have drawbacks like this, they're the big money's going to analyze it, but I have a feeling they're not just going to start capitulating right away. So I knew a bottom had to be coming in, and I've actually used a few of the retail gas stations, like those big trucker stations that you have throughout the country.
Yep.
And you could see that the prices dropped really hard, got down to about 250, 240 range, but the velocity of the drop began to slow. And so that kind of gave me the hint that a bottom may be in now for the length of time. I don't know, but do you think we'll stay down around these low 50s for the foreseeable future? Where do you think we'll probably end up at the end of Q1 in 2015?
I see. If you go look at a chart of WTI or you go look at a chart of Brent, it doesn't matter either one, but I watch WTI just because I have clients in Texas and I like the whole idea. I love, by the way, the names of oil. I mean, they sound really great. West Texas Intermediate or Texas Sweet Crude. I mean, I feel like I'm going to a craft brewery or something and getting something really good to drink instead of something to burn in my car.
Yeah, right.
But if you go look at the WTI chart, oil has a very recursive price strength. It just absolutely is recursive. It goes down at one angle and it actually bounces back at almost an identical angle. In addition, oil price spikes and drops almost follow back, and they almost always retract the same amount. So if I'm following that strategy and I'm thinking my bottom is somewhere under 50, but probably above 45, it appears to be that appears to be a bottom. If that's the bottom, then it ought to bounce back up into the mid-60s for a while. And then I would say the other thing that's weird is going and looking at global demand and global supply. There is not a giant supply glut, nor is there a significant drop in global demand. So I'll go back to, I would predict if we're talking next year at this time, which I hope we are, you'd be seeing oil in the $80 range again.
That's what I'm thinking too. I mean, it's got to come back up. This just seems beyond excessive, this drop here in oil, and just the fact that it just keeps getting hit down so hard. Now, looking at oil, do you think that there's any real benefit to the consumer? Because I've been one of the individuals out here that doesn't really believe that this impact is anything material on the consumer, especially considering some of the talk that I've heard that gas at the pump being down $1.50 means people are going out and buying SUVs. You were talking about the net benefit somewhere between 100 and 200 billion. I think that was annually for the decline here. That is substantially lower than some of the estimates I've seen from individuals out there in the high 600 to 800 billion range. So
I'm going that number based on how much we're losing from the oil sector and then how much we're gaining from the consumer sector. So that's a net number.
Okay. Now,
because I mean, if you're out in North Dakota and you're a geologist, this isn't good for you.
Oh yeah, it depends where you are. It's all relative.
But if you're you and me, and we're driving down, I mean, I was coming in today, and it was $2.19 a gallon here in Michigan, and we have expensive gas here. So at $2.19 a gallon with my family of 5 drivers, that's $10,000 in my pocket.
Wow.
But interestingly enough, that's a flat $10,000. If I'm another family of 5, it's $10,000. Doesn't matter if I make $45,000 a year or $145,000 a year. That's $10,000 in my pocket, at least for a year, if I can do it. Mm-hmm. And that actually does 2 things, in my opinion. It elevates consumer sentiment, which, as we know, has a direct correlation to market valuations and PE multipliers and a whole bunch of other things. Mm-hmm. The second thing it does is it is actual money in the consumer's pocket. But, I mean, take the Fed's current action. Low oil prices are low inflation. They are lowering commodity prices and lowering the cost of everything. and increasing the value. I mean, really, literally increasing the profits and lowering the prices on everything from food to shipping to everything. So in literality, it is, it's really a giant bonus, and it's a QE size bonus that didn't cost us anything. I mean, it cost us a tiny amount in terms of maybe about 1.4% of total GDP comes out of fracking in South Dakota. About 2.8% of our GDP is energy in this country. And so if we lose it on that side, we're gaining it back on 96% of our economy, getting a benefit from low oil prices, at least temporarily.
We should have done this in the first place, I guess, huh? Probably would have been a lot more beneficial back in 2008, 2009 to drop these prices.
We should have went over to the Saudis and said, by the way, do this, increase your supply. That would have really worked out for us. What the really funny part is that when I'm thinking about this, I go back to '08, and do you remember in '08, oil hit $145 a barrel?
Mm-hmm.
And everybody went, oh, my God, this is terrible. Oil's going to keep on going up. And somebody asked me the question. I go, no, it isn't. I said, I've been out in Wyoming. As soon as oil gets above $100 a barrel, they start drilling for oil. And now I say, oh, my God, look, oil prices are, down about 50. I go, you got to understand, the Saudi Arabian country, the country of Saudi Arabia has one product, oil. The Russians have 46% of their economy in one product, oil. They need it at $100 a barrel to make their country work. And so the folks who can change the price, we can't change the price. I mean, we can lower our fracking for a while, but folks who can change the price are the ones who absolutely need to change the price. So it'll go back up. There's no question. It's not going to stay down like this forever. It's amazing how short our memories are. But I always like to say, you don't measure the distance from Detroit to New York with a ruler. You measure it with mileage.
Yeah, perception's everything out here. Now,
right.
With oil going down, what do you think that this is going to mean for the dynamics of the way the oil system works? I mean, how do you see downstream guys getting, are they getting damaged a little bit more than the upstream guys? How are shipments coming in with oil? What do you think the dynamics going to play here, through the refiners? Because I've been watching 3-2-1 crack, and it's been slowly climbing a little bit, and I use that as like a proxy into refiner margins. It's not perfect, but I've been noticing that it's been rising. So I would like to get your view on the upstream downstream dynamic.
The refiners and the pipeline guys will still make money because it'll still move. The ones who are going to get hurt the most are the leveraged frackers and the leveraged, the wildcatters out there. They're going to get hurt. The deep water rigs have been pounded unmercifully, and they actually have some of the cheapest oil in the United States. So watching some of this deep water, the small deep waters are dangerous, but some of the large deep water rigs are still good. I'm actually looking at the big producers because that's the easiest play. Mm-hmm. And so the easiest play is looking at a Chevron or an Exxon, and they seem to have anticipated the crater. I don't know, maybe the folks there that are looking at that is that I'm seeing, Chevron's moved back up to 109 roughly, off of a bottom of 100, and that's a significant move. That's a 10% move in just a few days, and then it's come off of for the year, a pretty big high. So Chevron's a good indicator. It's a bellwether to me. Exxon's a bellwether, and I think those kind of reactions say I'd go for the big boys as opposed to the little boys right now. I'd stay away from the energy service companies. I'm just staying away from those. I don't have enough courage in that. I'm not saying they're going to go back and start drilling again soon. It would seem to me this is about a year before we get anything back anywhere toward the 100. So maybe longer than that. The other weird thing is I always thought, everyone talks about geopolitics. There's a bunch of guys over in Iraq and Syria that could change the whole complexion of oil really fast. All they have to do is go south. I mean, so everyone says, oh gosh, oil's just going to stay down. And we make these automatic presumptions and make a linear interpretation of something that's very complex. So I'm going with the oil will bottom out, and I'm going to go play the oil players after that. I'm going to go play the oil companies.
You were talking seed drilling, and not seed drilling, but you're talking seeds, and I'm curious because I was doing a little reading and I came across a realization from one of the guys that I was reading that it looked like the margins for guys that are drilling on land were actually performing better than those who were drilling out in the water. Do you have any input to anything to this effect? And
if you're drilling on land, if you're in old Texas fields, you're cheap. Mm-hmm. I mean, that's the same thing as being in Saudi Arabia. So if you're in an old Texas field, you're cheap. As I understand the price per unit, some of the Bakken is in $40 range. Some of Eagle Ford is in the $40 range. That's what I've understood it to be. But some of the deep water rigs that have already been running, are running even a little bit lower than that. So to drill a deep water rig, of course, is prohibitively expensive. But to have an existing deep water rig that's already going, not quite as expensive. Of course, you got storms and all those other things that come into play. But I thought the cost on a deep water was a little bit lower in some cases, and it's who's got the deep water rig. That's why I'm back to Chevron and Exxon. They're the owners they're the beneficiaries of the rig.
That's kind of some of the dynamic I was looking at here because we were talking about oil earlier. I think I talked about this. I don't know if the audience or me, if I had brushed across this on Wednesday, but there was a dynamic at play here when oil was going up to 150. Everybody started looking at solar as some sort of alternative energy source from the consumer perspective.
Yep.
They're saying, consumers don't want to pay this much for oil, let's go into solar. Now we've had this collapse to 50, and I was bringing up, hey, there's a scenario here where it doesn't seem like oil is as appealing anymore from a banking perspective. Because if you have to lend money out to these operations in order to go out and do a 20 to 30 year project of drilling for oil that's very highly capital intensive up front, the bank's going to require a rate of return on that. And if this end
Right.
product is now cut in half, it almost seems like the dynamic in the oil system would lead the banks to no longer lend there and turn and start lending to a place like a solar energy source that looks like it could have a more consistent end user price just because of the availability of sunlight, as opposed to having to go out and spend a whole bunch of money trying to drill for oil and only to find none or come up short. So I was wondering, do you kind of see some of the dynamic with cheap oil and the fact that it's been driven down so much, and aside from the Exxon and the Chevrons that actually own their own rigs, could this be problematic for some of these smaller firms that rely on bank lending? Do you think the banks might actually walk away from oil and kind of start investing a lot more in solar?
Yeah, well, that was a two-phase question. And the first is,
Sorry.
do I think there's going to be a relationship with the banks to small drillers? And the answer is definitely yes. But let's take one step back and look at oil in general. Oil is not all spot price. I mean, right now the spot price is down, but the contract price goes all the way into years and years and years. Delta does not buy oil on the spot market. Delta only buys the excess amount of oil they need on the spot market. So Delta's been contracting for oil for years. They've got long-term contracts that are in place. Those have been in place for a long time and go out a long time. The same thing with big fleets. They'll buy oil into long-term contracts. So there's a whole bunch of the oil market that's not affected by this downturn directly. The short-term drillers definitely are a bigger risk. And of course, if they're playing off a spot, then the banker's going to say, you know what, with oil at $50 a barrel, I'm not going to lend you money right now because it costs you 40 to get it out of the ground, and this rig isn't worth as much. Similarly, I would say you're going to see a drying up of the limited partnerships doing some of the drilling. That was, what a wonderful thing. You go out and drill a well and you hit it and you're making a nice royalty contract coming in. Now your royalty contract's basically cut by 70 or 80%. So yes, you'll clearly have that. The other question, and I'm pondering it too, and I don't know the answer to this. I don't think alternate energy is going to die because of the short spot price, but I do think consumer behavior is going to change. So, I read an article the other day that said, go out and buy your electric car now because it's going to be really cheap. I thought about it and said, well, that's might be logical. I mean, the hybrid cars and the electric cars are dropping off, and truck sales are going up because, again, we go to that consumer perception. The consumer perceives things are better, and they become better. It's that upward spiral of how I think things are going to be, so they become that way. Long term, we won't be out of alternates. They're still going to be around.
Yeah, that's what I was thinking too. I don't see that going away. There's always going to be people that want to do something different, and I'm kind of glad that the industry's there and offers that up to individuals. It's just a matter of making the change and getting to it because people get stuck in their routines.
Right. It's not going to. The Tesla sales aren't going to go down, and F-150 sales will probably go up for a while. But I don't think it's going to be a gigantic change unless this really does stay low, and I really don't believe it's going to stay low.
Do you think there'll be any political pressure coming up in 2015? Anything that could have a huge impact on the oil market, at least here specifically in the U.S.?
Not in the U.S. I think right now the political landscape is starting to define itself, and oil is not a defining issue right now, or energy is not a defining issue. I think there might be a little bit, the pressure to go drill has gone way down. The pressure of going into something like Anwar has gone way down. This will probably take some pressure off of the Keystone Pipeline, but I think right now the way the political landscape is forming out is they're going to call out anybody who doesn't vote for Keystone. And Keystone's still got this huge construction aspect going on. So I think Keystone will be reduced in its importance right now. Mm-hmm. But think about it. Congress and the president have a lot cut out for them. There's Obamacare at the Supreme Court. There's corporate tax reform. There's individual tax reform. There's immigration. There's Keystone. And I think Keystone moved down the path a little bit, moved down the line a little bit in its level of importance. If oil was $100 a barrel, we'd be Keystone on the top of the list.
Yeah, it's whatever can emotionally twist your nerve and get a reaction out of voters in order to, spark them to go on their team's side.
Right. So if you go to the voter and say, "Hey, we need an oil pipeline," they go, "Oil's really cheap. Do we really need an oil pipeline? What else do we need?" That's what I'd look at.
Mm-hmm. And that's It seems like the dynamic in the consumer is going to change. You were talking earlier about stronger consumer sentiment. And that's something I was looking for coming through the wintertime. And I was actually, talking to a couple buddies and just saying, I can't believe the Fed actually pulled this off. They were able to lift asset prices and do it for a long enough period of time that people seem to have forgotten about the pain of the crash. And instead of actually looking at intrinsic growth of, economic valuations, we're just dealing with another cheap, bubble that's been driven by the Fed that's basically based on relative valuation, not intrinsic valuation. So now that prices are down, consumer sentiment gets happy. People are willing to spend. I'm going to be looking hopefully for credit cards to go up, use of credit cards increasing. I don't know what's going to happen with the deposits of individuals, but it seems like the consumer is going to get a lot more excited again and definitely be willing to travel a lot more. And this boost through December should help get people excited again, after Christmas time, willing to go out and buy food, travel a lot more often. So I could see oil
in Germany, the sentiment just hit a new 8-year high. I mean, today that was announced today.
Yeah, unreal.
So we're seeing that. We're seeing our consumer sentiment at a high. We saw the biggest move in the market, in a long time. And we've got. I mean, if you put it in perspective, I mean, my Christmas party talk is everybody will say, "Hey, Leon, what do you think?" I go, "Well, let's look at it. Low oil prices, low inflation, low interest rates. Everybody's happy. Market's doing well. What do you think?" And they go, "Okay, I'll go with that. I could go with that."
Yeah, I know, that's amazing. All right, Leon, I have to cut you loose. We're gonna get ready for our next guest here and wrap up the show.
Great.
So thank you very much for coming on. It was fantastic
Great talking
to you. Good luck with everything. I wish the students well. And ladies and gentlemen, that was Leon LaBrecque, founder and CEO of LJPR. Thank you, sir.